Welcome to NM's Arena. In this video, we are going to discuss portfolio analysis in strategic management. Now let us discuss what is portfolio analysis. First of all, the term portfolio. This term has been taken from investment management and it is introduced in strategic management in 1960s, which means a combination of different securities with different risk and returns. So portfolio analysis means it is a set of techniques that help an organization in making certain strategic decisions with regard to what to do with different businesses or different products. A portfolio analysis is a two-dimensional technique. It includes risk as well as return. Different methods are there for analyzing a portfolio. All these methods considers these two dimensions. There are a number of techniques for analyzing the portfolio. It includes BCG Growth Share Matrix, GE 9-cell planning grid, product or market evolution matrix, and directional policy matrix. Among these, the BCG Growth Share Matrix and GE 9-cell planning grid or GE grid are the most commonly used techniques. First of all, let us discuss the BCG Growth Share Matrix. This method is developed by the Boston Consulting Group of USA, from which it has evolved the term BCG, B for Boston, C for Consulting, and G for Group. It is also called as BCG Matrix. This matrix may be used by an organization to analyze its position in the market, or it can be used by an organization to analyze which of its business units can be developed and which of its business units can be divested. For this purpose, the BCG matrix uses two dimensions as market growth rate and relative market share. And each of these dimensions is again divided into 2 degrees as high and low. Now, the market growth rate indicates the annual growth rate of the market in which the business operates. How the market grows, whether it grows at a high pace or at a low pace. That's the relative market share. It is a share relative to that of its largest competitor. What is the share of this particular business unit when compared to that of the largest competitor? Based on this, the matrix is divided into 4 cells, each representing a different type of business. The first cell consists of stars. The business with high market share in a high growth rate market are called stars. They represent the best profit and growth opportunity business unit in the organization's portfolio. So, this type of business needs to be nurtured and groomed for the long run. So, simply, it is a business which has got a high market share and the business is also existing in a high growth rate market. That means it is the most important star of the business portfolio. Now coming to the next cell, it is the cash cow. The business with high market share in a low growth rate market are called cash cows. These businesses will yield substantial cash surplus over and above their investment requirement. But it is not a position very attractive in the long run. But it can be used for generating cash to meet the organizational requirements. The situation may not exist for a long term because the growth rate of the market is not high. The share of that market when the share of that particular business unit in the market when compared to that of the competitors is high. So this position can be used to generate maximum cash flows. And the next cell is the question mark. The business which has got a relatively low market share when compared to the competitors and it is existing in a high growth rate market. So that is the problem of the business. The growth rate of the market is high, but that market is having only a low market share. So we can understand there is some problem with that particular business. The low market share makes them questionable whether the profit potential associated with the growth can realistically be captured. Now coming to the next type of business, it is the dogs. The business with a low market share in a low growth market are called dogs. These businesses have very low competitive position. The reason may be because of their high cost or low quality, or their marketing may not be effective. They have got very low profit potential as the market has also low growth potential and their relative share in the market is also very low. So they are not at all attractive from the long term point of view. Sometimes they may also not be generating enough cash to maintain their position in the market, especially in a highly competitive market. Therefore, such businesses may be divested. So, on the basis of this matrix, a business organization can decide which of its business units may have to be developed or invested more, and which of its business units may have to be stopped or divested. The star position, those business units which are in this cell, may have to be improved. And the cash cow, these cash cows can be used maximum to generate their cash inflows during their boom period. And the questionable business units, it has to be found out what is their fault in creating a high market share. And the dogs, they have to be analyzed their position. They have to analyze what is their problem. May it be the high cost or some other reasons. And most probably, this business unit may have to be removed from their portfolio. Another type of the portfolio analysis technique is the GE9 cell planning grid or simply GE grid. To overcome the weaknesses of the BCG Matrix, the General Electric Company of USA has developed this particular grid. That is why it is called GE, General Electric, GE grid. When the BCG matrix uses only two dimensions to analyze a particular business unit like the relative market share and the market growth rate, the GE grid uses a number of factors which is classified into two as industry attractiveness and business strength. But each of these dimensions are classified into three degrees of dimensions like high, medium and low. Now the business strength considers market share, profit margin, customer and market knowledge, the ability to compete, competitive position, technology, management caliber, etc. to measure the business strength. So these many factors are considered in measuring the business strength. And in the case of industry attractiveness, the factors like market size and growth rate, industry profit margin, competition, seasonality, and cyclicality, economies of scale. Then the technology and social, environmental, legal, and human factors all are considered in the industry attractiveness. The GE grid is also called stoplight strategy model because it uses three colors green, yellow, and red. Hence, it is called stoplight strategy model. Now, the first color that is the invest or expand. Those business units coming in this area can be used for expansion or more investment can be made in this business units. In this zone, a business has an opportunity to grow through further investment and expansion. So this zone is characterized by business strength as well as industry attractiveness. And in this case, the extreme left hand corner, the high position, business strength high and industry attractiveness high. In that position, It is the most ideal situation for growth. However, the business may not remain in this situation for a long run because this happens only in a few cases. As when a business unit is in this position, it will attract other players unless there are strong entry barriers. The other two green cells, they are more realistic description of the business situation. In high attractiveness and average strength cell, an organization can grow, but it may become dangerous for it if it does not build a strength in its business. And in the third case, the most realistic situation for growth. Here, the industry attractiveness is medium, and the business strength is also medium. So it can generate a competitive advantage for itself, which may act as an entry barrier for the other firms. So this the area marked in green. These business units can be used for further investment or expansion. The next is the yellow group, that is select or earn. It represents a mixed situation and hence it presents the opportunity for selective earning. It is it shows either of the determinants, either business strength or the industry attractiveness is either high or both stand in the middle. The average strength with medium attractiveness and the strong strength with low attractiveness indicate a good position to earn profit with the present level of capacity. And the third cell provides a flexible situation. It represents continued earning because of high industry attractiveness, but it suggests the scope for improving strength. And if that is not possible, the business may be put in the category of a question mark and may be used for divesting or stopping the business. And in the case of the strong strength and low industry attractiveness, either the organization can go for some sort of vertical integration, either forward or backward, depending on the nature of the industry, or may seek diversification where the present strength can be utilized. Anyway, the yellow area, those business units coming in this yellow color, that can be used for earning. Now comes the next cell, that is the red cell. This is the most dangerous situation a business exists. The organization has to stop that business, but it can be in two categories: harvest or divest. Divest means immediate stopping of the business, and harvest means step by step stopping of the business. In the case of low business strength and medium industry attractiveness, if that business unit is coming in that cell, they may go for harvesting. Or even if the business strength is medium and industry attractiveness is low, they may go for harvesting. But when both are low, the business strength as well as industry attractiveness are low, the business unit must be immediately stopped. The harvesting involves a decision to withdraw from a business, but the withdrawal is not immediate. In the initial stage, focus must be on cost cutting, especially on items like research and development, advertising, etc. Here, the objective is to earn short term profit as the business is not attractive in the long run. So, only these two cells can be used for harvesting, and the bottom right cornered cell, that is used only for immediate divestment because keeping on that business unit will incur more and more losses. So this is how the GE grid is constituted. Next is the product or market evolution matrix. Apart from the other two matrices, this matrix uses the stage of product or market evolution and the competitive position as the two dimensions for finding the position of a business. And in this case, it is again classified, each dimension is classified into a number of other dimensions or degrees. The competitive position as strong, average, weak, and the stage of product as development, growth, shakeout, maturity, and decline. And here comes the grid or the matrix. In this case, the color is not important. I have used the color just to make it more understanding. The position is of importance. In the case of GE grid, there is three colors, red, green and yellow. But here, the colors are of unimportant. Now, coming to the grid, various businesses of an organization can be shown on this matrix, taking into account the competitive position and the market evolution stage. So the businesses falling in the strong competitive position and the development and growth market may be the future winners. The business units coming in the dark blue area, they may be future winners. And those business falling in the average competitive position and in the development and growth market may be converted into future winners by increasing their competitive position. They are having an average competitive position. This competitive position can be increased and then they can also be converted into future winners. So there is also a position having scope for improvement. Then coming to the next position, that is the business falling in the weak competitive position in any market. The red area, the light red and the dark red. All these businesses are losers, we can say. They are potential losers. Therefore, they can be considered for divestment, especially those coming in the mature and the declining market. The dark red area, those business units coming in the dark red area, they may be used for divestment, immediate divestment, and coming in the light red area, they can be considered for future divestment. Anyway, the red position is not good for a business unit. Then the business falling in the strong competitive position and in the mature and the shakeout market. This can be looked upon as the cash cows, as they can be used for cash generation activity. They are having a strong competitive position, but they are in the shakeout or maturity stage. That is the green part. They can be used for cash generating, but they cannot exist in the long run until they improve their position. Then the next one is the business falling in the average competitive position and in the saturated and the declining market. That is the yellow area. They may also be considered for future divestment, not immediate divestment, but we can say harvesting or future divestment. These business units can be considered. That is those coming in the yellow area. And the middle part, the purple area, there is a medium point or an average point, can be improved or it can be considered for divestment in the future. If the company is able to improve their competitive position and their market evolution stage is also coming better, or even if it is there in that particular shakeout position also, if they are improving their competitive position, those business units can withstand the competition in the market. But if they are coming down to the yellow or to the red part, they may also be considered for divestment. The Directional Policy Matrix or the DPM. It is developed by the Shell Chemicals UK and they uses two dimensions such as the company's competitive capabilities and the business sector prospects. They use these dimensions to choose the strategies. And each of these dimensions are further divided into three degrees. The competitive capability are divided as weak, average, and strong, and the business sector prospects are divided as attractive, average, and unattractive. And the matrix formed here consists of 9 cells, and the weakest cell is the left top corner cell, the unattractive and the weak cell. So the first cell that consists of the business units which are unattractive in the business sector prospects and have weak competitive capabilities. The company itself is weak and it is also operating in an unattractive business sector prospect. In this case, the strategy to be adopted by such business unit is to divest or to stop the business so that they can use these resources for some other purposes or some other business units. The second type of cell or the second type of choosing strategy is where the business sector prospects are average and the competitive capabilities of the business is weak. In that case, that unit can choose to phased withdrawal. That is step-by-step withdrawal because the business is not likely to earn enough as compared to other businesses in the portfolio. So, they can withdraw from that business area step by step, not all of a sudden as in the case of divestment. And the third type is where the business sector prospects are attractive but the particular business unit is weak in competitive capabilities. In that case, they may double or quit. The double means the business unit can allocate additional resources to take the advantages of the attractive business prospects. Or if it is not possible, if it is not possible to allocate these resources for improvement of that business unit, then the next option is to divest or quit from that scenario. Now coming to the next cell, unattractive business sector prospect and average competitive capability. Here also phase by phase withdrawal can be adopted. And next cell is where both are on average. The company has got average competitive capabilities and the business sector prospects are also on an average. In this case, a custodial method can be adopted. Either the organization may bear with the situation and make the situation more better by adopting some new technologies or some allocation of the resources or for going for more investment or something like that, or it may divest this to concentrate on some other businesses, either improving the same business or stopping that business to focus on some other business units of the same organization. The next is where the business sector prospects are attractive but the competitive capabilities are only at an average. Here, the company has to try more harder to take the advantage of the attractive business prospects. That is a strategy to be followed in this situation. Now comes the next one where the business sector prospects are unattractive but the company is very strong. It is a situation of cash generation. The business has got strong capability but unfortunately the business prospects are unattractive. So this situation can be used for cash generation and no further investment is required because of the unattractive business prospects. And the next is average business sectors prospects and the strong competitive capability. Here it is a situation for growth. So the company can allocate more resources in the form of product innovation through research and development or creation of additional production capacity so as to fight in the market to increase their market share. And the last one is the most important one where the business sector prospects are attractive and the company is also very strong. Here they can become the market leader by allocating the additional resources. And once the market leadership is established by innovation, they have to maintain their leadership position. So these are the strategies that a firm can choose with directional policy metrics. Thank you for watching this video. For more videos, subscribe the channel and click the bell icon.